Risk profile is used for creating an asset allocation portfolio for investors. Return is a result of the portfolio that you build out of asset allocation, and that asset allocation is the output of the risk profile that you actually get. Your risk capability during your 20s or your 30s will be very different from the risk capability that you have in your 50s or 60s, and it will be very different when you are in your late 70s or 80s, right? The other thing is that investors always think advisors are return managers. Advisors are primarily first risk managers.
Hello everyone, welcome to Moneyskills by Scripbox. I am Nirav and today we are going to talk about risk profiling. We'll cover everything you need to know about risk profiling. So let's get started. Today on the show we are excited to have Mr. Meyyappan, who heads the advisory department at Scripbox. He's going to share with us his wealth of knowledge as well as experience on risk profiling. Welcome to the podcast. It's great to have you here, Meyyappan.
Hi Nirav, thanks for having me on this show.
So, Meyyappan, getting into the topic of risk profiling for today. What exactly is meant by risk profiling in the context of portfolio management?
See, risk profiling basically helps you to understand the risk-taking capacity of the investor, right? So, before we get into that, we need to understand what risk is. For some investors, risk is a loss of capital. For some of them, it's opportunity cost, or it could be hazard, or it could be volatility. So there are multiple meanings for different investors. But the objective is basically to understand the risk-taking capacity. And that's the objective of the risk profiling questionnaire.
So why is risk profiling important from the perspective of portfolio management?
See, risk profiling helps us to manage risk for the investor while building the portfolio. Risk profile is used for creating an asset allocation portfolio for investors. An asset allocation model is a mix of various instruments like equity products, debt products, international products, or let's say commodities like gold, right? So each of them have different sets of correlation between them. So that what does correlation mean? Correlation means that a relation between two different instruments, in this case two different asset classes, they don't move in the same direction. If we say the correlation is negative, so here we try to build portfolios such that the correlation between asset classes is either low or it's negative between themselves, so that we manage risk and the volatility of the portfolio at the overall level for the client. So that's where risk profiling actually helps us to build portfolios in an efficient manner.
And what typically happens is the risk profiling is not properly communicated.
See, if the risk profiling is not properly communicated, what happens is you end up either building a high risk portfolio or a low risk portfolio, right? So if you build a very high risk portfolio, the investor may not be able to digest that risk because of either loss of capital or because of volatility that happens on a day-to-day basis. If you build a very low risk portfolio, then what happens is you will not be able to achieve the financial requirements or let's say financial goals that the investors may have. It's important therefore that you get the risk profile correct for the investors, which aids into building a right asset allocation portfolio.
So Meyyappan, how do you go about creating the risk profile of a customer?
Risk profile, most advisors have their risk profile questionnaire. And that questionnaire can be could count anywhere between 7 questions, even 25, 30 questions, depending upon how many questions each advisor wants to have. You also need to optimize the number of questions, right? So if you have very low questions, you might go wrong in judging the risk profile. If you have a very large number of questions, the investors may not have the patience and the willingness to run through the entire questionnaire, right? So it's important, therefore, that you have the optimum number of questions, but at the same time ensure that you capture most of the important parameters. Now, what are the important parameters? The parameters of 2 parts primarily. One is the ability to take risk, and the second is the willingness to take risk. Ability to take risk is decided by quite a few factors, which is like your age, your income levels, your standard of living or expenses, your assets, liabilities, then the number of dependents in your family, so the periodicity of the income, whether you have regular income or not, and your periodicity of even expenses and liabilities, like the way you have EMIs, right? So all of these matter when you build, when you're looking from a ability perspective. In terms of willingness perspective, it is primarily psychological in nature. It's a way you have been brought up. It's a way about your belief systems, your thought processes, how your family members influence your thought process, etc. So it's more about psychological in nature. So these are the two factors within which are used for understanding the risk profile of the client. It need not be monetary. It can be even non-monetary as well, right? So those factors do influence your willingness to take risk. It could have happened across your lifespan at any point of time, but each critical instances sometimes might influence your ability to take risk or willingness to take risk. If you look at the year 2020, when the markets crashed, how did you react to it, right? So was it something that you had a fear and then you never came back to markets, or were you invested into the equity markets for a longer period of time? So all of these matter.
Sure. And how often do the risk profiling of the client changes? And what, in your opinion, should be the periodicity of doing the risk profile?
See, risk profile we need to do this risk profiling on a periodic basis. Typically, we recommend on an annual basis. It could be more or less than this periodicity, depending upon the situation of the investor, right? So, but yes, risk profile can change over a period of your lifespan. Your risk capability during your 20s or your 30s will be very different from the risk capability that you have in your 50s or 60s. And it will be very different when you're in your late 70s or 80s, right? So these factors will keep changing. So it's very important that we need to do a risk profile. We need to look at reviewing risk profile on a periodic basis.
And what Meyyappan typically happens when the ability and the willingness to take the risk are at different levels?
Ability to take risk and willingness to take risk, we at Scripbox measure in 3 points of scale: high, medium, low. Somebody else could measure on a 5-point of scale. Somebody else could measure it at a 7-point scale. So it varies from advisors to advisors, right? So, but the key thing is, yes, there are situations where your ability might be high and your willingness might be low, right? If your ability is high and your willingness is low, what we typically do is we start with a lower risk profile for the client, and then we coach them. We work with them over a period of time to improve their willingness to take risk, and that comes only when the investor runs through market cycle or an economic cycle, where you will see one top and one bottom, right? So that's the way when you have a high ability and low willingness. When I say high ability, you obviously have the financial situation in your favor. The other situation is that you can have a low ability and a high willingness. So here, what happens is you might be willing to take the risk, but you don't have the financial situation to take the risk. So in this scenario, what we'll have to do is we'll have to work with the client and wait until the financial situation of the client reaches a certain level where you can move it up to be in line with the willingness. So it's always a mix of both willingness and ability, right? So you need to moderate between the two. And wherever there are extremes like these, then you will have to work and coach the client to get the client or the investor to that level that is necessary for them or apt for them.
So that sounds exhaustive. So what is the extent to which the risk profiling is done?
So risk profile is done at the individual level. What we typically also do is that there might be times when you might not operate individual portfolios, but we will operate goal-based portfolios. If it's an individual portfolio which is operated by the respective individuals, then it's the specific straightaway mapping of risk profile of the individual to the individual portfolio. But if it is done at a goal-based portfolio, then we will have to work with the investor and then understand also the time horizon and also understand the importance of the goal, and then modify apt the risk profile for the respective goal-based portfolio.
So in case of corporations or other such entities, how do you profile the risk?
See, in the case of corporates or trusts or let's say partnership firms, you typically can't do risk profiling because there's no person behind it, right? So there's no human behind it. and therefore you can't understand the willingness to take risk. So in these scenarios, what we typically do is we'll have to work with the owners or the promoters or the senior management of the corporates or the partnership firm or the trust to set up a statement called as investment policy statement. So the investment policy statement is a documentation which consists of some of the factors like what's the purpose for which the investment is being made, for what duration, and what's the type of risk that this particular entity can take. So there are quite a few factors like these, basis which we decide to operate a portfolio within the parameters laid out in the investment policy statement. So basically, this investment policy statement is agreed upon in writing between the investor and the advisor to operate the portfolios in a specified manner as per the rules laid down in the investment policy statement.
Sure. So, Meyyappan, can you have a risk profile which is different from the outcome of the risk profile questionnaire?
See, basically, advisors always get this request that from the investor saying that, hey, I got this as the output. This output is not in line with whatever I was expecting to, right? So there's a bit of a mismatch which always happens here. So it's very important for the advisor and investor to sit down here and then discuss a little bit more about the details of why and how this output has come up, right? Typically, we take the combined output of the ability to take risk and the willingness to take risk. And then we have a scoring pattern basis which combined risk output is arrived at. It's always safer to take the lower risk profile to start with for the investor and the advisor. And then if the client is keen to move up on the higher on the risk profile and willing to take more risk, then gradually moving up. I think starting with a higher risk at the higher risk profile as a starting point is not recommended, because it could put the financial situation or the financial portfolio in a jeopardy in the longer run. So it's important that you manage the expectations of the investor and then arrive at a risk profile which is closer to the actual output, and the investor ideally should start with the output which the questionnaire gives us.
So, Meyyappan, traditionally we've always observed that people are averse to fallacy or to sharing their insecurities. So with this respect, what would be your advice to investors while attempting the risk profile questionnaire?
See, typically we request investors to attempt the questionnaire very truthfully, right? Otherwise, what happens is the output could go wrong, and then you end up with a wrong asset allocation or an inappropriate asset allocation, and that could either mean a different level of risk and volatility in the portfolio, and also different level of return expectation from the portfolio. So it's very important that you attempt the questionnaire in a truthful manner.
So what is the outcome of a risk profile typically look like?
Once the risk profile questionnaire comes up, so the next level is to get the appropriate asset allocation for the client, and different risk profiles will have different levels of asset allocation. For example, a high risk profile might have higher weightage towards Indian and international equities, but a low risk profile might have more towards debt, etc. So there is also gold, which is a different asset class with different levels of correlation between equity and debt. So the idea is to build the appropriate asset allocation portfolio which works for the investor in the long run, both in terms of risk management and also ensure that he's able to achieve his financial goals and requirements.
What are the usual misconceptions which are governing the risk profiling exercise?
A high risk profile would mean a high equity allocation and therefore a high return portfolio. and this is not always the case, right? High risk portfolio also means that there could be a very sharp drop, and what will happen is typically you might end up exiting at the bottom if you can't take that loss. So typically investors want to have aggressive portfolios at the top of the market and a very conservative portfolio at the bottom of the market, and this is actually the case in today's world. You should be doing the opposite, unfortunately, right? While risk profile is not dependent on markets, right, which I want to categorically mention, but the point here is that let the risk profile be as it is, and risk profile will also lead to an asset allocation which has a balancing mechanism. So typically when you have invested a certain portion of allocation in equities, let's say you have a balanced asset allocation portfolio, 50% equity and 50% debt, right? And tomorrow, and you have a range, let's say 10% plus or minus for equity, right? And with the minute when I use the range, so minute the 50% equity allocation crosses 60%, then you start skimming off the equity and go back into debt, right? So what happens is it's an indirect way of actually moving your profits into a class which is safer. And at the same time, the vice versa will happen when the markets are at the bottom, right? So when the markets are at the bottom, your equities would have already been at a lower level, market fall also, and then you will move some money from the debt portfolio into the equity portfolio, which will also be like equivalent of buying at the lower prices, right, in equity. So that's asset allocation in a way aids you to buy low and sell high. So we'll work within a specified range of the asset allocation model to ensure that your overall risk and volatility is managed. The other thing is that investors always think advisors are return managers. Advisors are primarily first risk managers. Return is a result of the portfolio that you build out of asset allocation, and that asset allocation is an output of the risk profile that you actually get.
So Meyyappan, you mentioned that risk is a dynamic approach, right? While market itself does not warrant or influence risk-taking appetite, but may psychologically influence the willingness of the investor to take risk, right? So with all of this dynamicness, how do you think that on a practical day-to-day scenario, how strictly is the risk profiling observed for investors?
See, what initially it's a little bit of most investors are okay with the risk profile output, and therefore it's not very complex to start building portfolios for them on an asset allocation model. But there will be sometimes difference of opinions between the risk profile output and the investor. So you will have to work together to get an appropriate risk profile output. In case you want to adjust the risk profile, it's better to put it in writing so that the client also understands what's the implications of it, and the advisor also has communicated his output of the risk profile and the impact of the risk profile, which is a part of his duty.
Meyyappan, you mentioned the importance of asset allocation. How would a very high risk product in a portfolio be placed of an investor who has, let's assume, a medium to low risk?
See, just because your risk profile comes out as medium doesn't mean that, or let's say low, doesn't mean that you will not have a high risk product. What it means is that the weighted average risk of all the products should come closer to your risk profile output. So you will have, say, a higher weightage to a safer product and a lower weightage to a high risk product if your risk profile is relatively low. And while your risk profile is high, it would mean that you will have a high weightage towards more volatile asset classes like equities, and a lower weightage to debt and debt related products or safer products. That's how we manage the risk level of the product with the risk level as mentioned in the risk profile questionnaire.
Thanking our regulators, they have a concept of riskometer for every mutual fund scheme, right? So how do you think so that the riskometer which is mentioned on the mutual fund fact sheet, how is it accommodated in the risk profile, if at all it is?
So as I said earlier, see, this mutual fund fact sheet is a very good way of communicating risk level to the investors. And there are type of categories which is provided there, which is low, moderately low, then you have moderate, then you have moderately high, and then very high, right? So you have this particular level of ranking in the riskometer. So we do take the riskometers risk level into account when we actually build asset allocation based portfolios for the clients. As I said, the weighted average of the products together, right? Because each portfolio will have multiple sets of products with in each asset class, right? So the weighted average of the weighted average risk profile of all the products in different asset classes should more or less come closer to the risk profile level as mentioned in the risk profile questionnaire. So that's how risk profile actually works along with the asset allocation based model.
And no, most of the risk is defined so that people can have a peaceful retirement, right? So how do you think so the risk profile pans out post retirement period?
See, this profile for the post retirement period is a little tricky, right? So what typically happens is once you retire, the most important thing that you will have to do with your advisors to understand whether you have enough corpus or not to sustain your lifestyle. So there are a lot of assumptions which go into understanding whether you have enough corpus or not, which could range from your lifespan. Obviously, you can't predict your lifespan, but it's better to have a longer lifespan built into your assumptions, along with your level of expenses that you plan to have for your standard of living. Obviously, see, everybody would like to maintain the standard of living, and therefore it is very important. It's something that is necessary for any investor for that matter would like to have the same level of standard of living or probably continue or move into a better standard of living, right, when they retire. So the aim is that you ensure that you have enough corpus at least to maintain your current standard of living. If you have enough corpus for your current standard of living, then you can continue your risk profile as it is. But let's assume the other two scenarios. If you have more than enough corpus, right? So then there are two things which can happen. You can increase your standard of living, right? Or alternatively, what you can do is you can take higher risk on that excess corpus over and above what you need, and then put it to work for your next generation, right? If you have a lower level, the scenario will have to be reworked. Either you have to work a little longer to ensure that you have enough corpus, or you might have to change your standard of living, which is a little difficult to adjust to, but sometimes you have to accept the reality, right? Because when you don't have enough corpus, your ability to take risk reduces, and therefore you have to tread with caution.
So Meyyappan, since I have you on the show, I could not have let this opportunity pass away, and I'll pretend that this is a question on one of the cue cards, right? So what is your personal favorite pick in the risk profile questionnaire?
See, almost every question in the risk profile questionnaire has its importance. Whenever we go for a new client meet, the first thing that we actually read is actually the risk profile questionnaire, because it gives me an insight of what is the client's ability and the willingness to take risk, and accordingly I'll be able to build portfolios for the client. So for me, the most important question is that I would ask the investor or the client is that how much loss have you seen in your portfolio earlier? There's a possibility the client may not have had a loss at all in his portfolio earlier, in which case that is something that we'll have to consider carefully, and then build the ability to take the risk for the client from the volatility perspective, because the client will take time for the investor will take time to adjust to that level of risk in case he's not seen the loss in the portfolio earlier. So that's one of my key questions. The other question I would ask is probably what's the percentage of allocation to different instruments in his existing portfolio, and this will also give me enough amount of insight for me to understand his capability to take his risk.
So, Meyyappan, very nicely explained. And if I were to wrap that up, if you manage the risk of an investor, indirectly you are also managing the expectations, and then therefore the returns are a byproduct thereof. Absolutely. Thank you, Meyyappan, so much for joining us. It was an absolute pleasure and a great experience for me to be on the other side of the chair when it comes to you. So, but sincerely thanking you a lot for joining us today.
Thank you. Thanks.